Have you ever wondered how to select stocks for your portfolio? Well, you're not alone. Today we're diving deep into the world of stock market fundamentals, focusing on stock selection and portfolio management. We'll shed light on the importance of choosing stocks wisely and managing your portfolio effectively. We'll also provide a sneak peek into the steps that will be discussed in further detail throughout the video. Understanding these steps will not only help you make informed decisions but also mitigate potential risk. First, it's crucial to understand your investment goals. The clarity of your investment goals can act as a compass, guiding your decisions in the vast ocean of stock market opportunities. Are you looking for short-term profits or long-term growth? Short-term investments often involve higher risk and potentially higher returns, while long-term investments are typically more about steady growth and resilience against market fluctuations. Then, consider your risk tolerance. Are you a thrill seeker, willing to risk more for potentially higher gains? Or do you prefer the steady but possibly slower path of lower risk investments? And let's not forget about your financial objectives. Are you investing for a comfortable retirement, to buy a house, or perhaps to fund a dream vacation? Each goal will require a different approach and strategy. Remember, there are no right or wrong answers here. It's all about understanding what you want to achieve and how much risk you're willing to take. Defining your investment goals is the bedrock of successful stock selection. Once you've set your goals, it's time to do your homework. Now, what does doing your homework in the world of investing really mean? It's all about research and analysis. You wouldn't buy a house without first inspecting it, would you? The same goes for stocks. Before you invest your hard-earned money into a company, you need to know what you're getting into. First on the list is fundamental analysis. This involves looking at a company's financials to understand its health and profitability. You'll want to examine things like the company's earnings, revenue, and cash flow. You'll also want to check out its balance sheet, which provides a snapshot of the company's assets, liabilities, and shareholders' equity. Think of it as a company's financial report card. Next, it's important to keep an eye on industry trends. Is the sector the company operates in growing or shrinking? What are the major challenges and opportunities in this industry? How does the company stack up against its competitors? These are all key questions that can help you gauge the potential risks and rewards of investing in a particular stock. Lastly, you should consider the overall market conditions. Are we in a bull market, where prices are expected to rise, or a bear market, where prices are expected to fall? What's happening in the economy at large? Understanding the bigger picture can help you make more informed investment decisions. But remember, research and analysis aren't about predicting the future. They're about gathering as much information as possible to make educated guesses. It's about understanding the risks involved and making decisions that align with your investment goals and risk tolerance. And here's a pro tip. Don't just do your research once and forget about it. Keep updating your knowledge as new information comes out. Companies and markets are dynamic, they change all the time. So your understanding of them should evolve too. Remember, thorough research and analysis can help you avoid costly mistakes. So, always do your homework before you invest. Your future self will thank you. Now that you have your potential stocks, it's time to diversify. Imagine your investment portfolio as a ship sailing through the turbulent waters of the stock market. Diversification acts as the multiple compartments in your ship, preventing it from sinking if one area gets flooded. In simpler terms, diversification is about spreading your investments across different types of assets to minimize the risk. It's not about putting all your eggs in one basket, but rather distributing them into multiple baskets. So why is diversification so crucial in portfolio management? Firstly, it helps to spread the risk. Each stock in your portfolio represents a slice of ownership in a company. If that company performs poorly, your investment could suffer. But if you own a wide variety of stocks from different sectors and industries, the poor performance of one or two companies won't sink your entire portfolio. Instead, the good performance of other stocks can help to balance out the losses. Secondly, diversification can enhance potential returns. By investing in a variety of sectors, you're more likely to catch the next big wave of growth. For instance, if you only invest in tech stocks, you might miss out on growth in the healthcare or renewable energy sectors. Diversifying gives you a seat at the table in a variety of industries. However, it's essential to understand that diversification is not a guarantee against loss. It is a strategy to manage risk and improve the potential for returns over the long term. Remember, the key is not to just diversify, but to diversify wisely. This means investing in a mix of assets that align with your investment goals and risk tolerance. In conclusion, diversification is like a balanced diet for your investment portfolio. Just as you wouldn't eat only one type of food for every meal, you shouldn't invest in only one type of asset. By spreading your investments across a variety of assets, you can navigate the ups and downs of the market more effectively and confidently. Diversification is the safety net of your investment portfolio. But your job doesn't end at just selecting stocks and diversifying. Your role as an investor is never quite done. One of the most crucial aspects of portfolio management that's often overlooked is the regular portfolio review. Why is this so important, you may ask? Well, let's delve into that. Market conditions are like the weather, unpredictable and ever-changing. They can affect the performance of your stocks in ways you may not anticipate. One day, you're basking in the sunny warmth of robust growth, and the next, you're caught in a downpour of market volatility. This unpredictability is part and parcel of the investment landscape, and it's what makes regular portfolio review so crucial. By regularly reviewing your portfolio, you can keep a pulse on the performance of your investments. You can identify which stocks are driving your portfolio's growth and which ones are dragging it down. This allows you to make informed decisions about whether to hold on to a particular stock or let it go. But it's not just about weeding out the underperformers. A regular portfolio review also gives you the opportunity to rebalance your portfolio. Rebalancing is the process of realigning the weights of the assets in your portfolio to maintain your desired level of risk and return. For instance, let's say you've originally allocated 60% of your portfolio to stocks and 40% to bonds. If the stocks perform well, they may grow to represent a larger portion of your portfolio, skewing your original asset allocation. This could expose you to more risk than you're comfortable with. By rebalancing, you can bring the allocation back to your original 60-40 split, ensuring your portfolio continues to reflect your investment goals and risk tolerance. Remember, the aim here isn't to chase after the highest returns, but to ensure your investments remain aligned with your financial goals and risk appetite. It's about making sure your portfolio continues to work for you, not against you. Regular portfolio review ensures your investments remain aligned with your goals. Because at the end of the day, that's what successful investing is all about. So, you see, stock selection and portfolio management is a meticulous process. It's a journey that begins with understanding your investment goals. This is the foundation of your investment strategy. It's like a compass in the world of investing, guiding you towards the right choices that align with your financial objectives. Are you saving for a down payment on a house? Are you planning for your retirement? Or perhaps you're aiming for financial independence? Whatever your goals may be, they should be the guiding force behind your investment decisions. The next step in this journey is research and analysis. It's the equivalent of a detective's work, requiring you to dig deep into the financial health and future prospects of companies. This involves studying financial statements, evaluating industry trends, and understanding market sentiments. It's not just about picking stocks with the highest returns, it's about picking stocks that are likely to provide sustainable returns over the long term. Remember, investing is not a sprint, it's a marathon. Then comes diversification, the art of not putting all your eggs in one basket. It's a risk management strategy that aims to spread your investments across various sectors, industries, and geographical locations. This way, you're less likely to suffer significant losses if one particular investment performs poorly. Diversification is about creating a balanced portfolio that can withstand market volatility and deliver steady returns. Finally, we have the regular portfolio review. This is your chance to reassess your investment strategy and make necessary adjustments. It's like a regular health checkup, but for your investments. Are your investments still aligned with your goals? Are there new opportunities that you should consider? Or perhaps there are underperforming stocks that you need to let go of? Regular portfolio reviews ensure that your investment strategy stays relevant and effective. So, there you have it. A quick recap of the journey of stock selection and portfolio management. It's a process that requires patience, diligence, and a strong understanding of your financial goals. It's not about chasing quick profits, but about building wealth over the long term. Remember, informed decisions and consistency are key to successful investing. Happy investing!